Has the price of silver hit a bottom? Well, that is the million-dollar question in the precious metals market at the moment. And there are a number of factors weighing on the precious metals market as well as on the global economy at the moment. And we're going to talk about several of them in this video. Now, you will want to stick around until the end because I'm going to cover a breadth of topics in today's video, but I promise I will be tying it all together at the finish. So definitely stick around. Now, starting off with the metal itself, silver, slightly off the lows of last week, but only marginally, up to about the mid $18 level. Last week on Thursday, we had the big sell-off. It touched down to just about 18 bucks. Gold at around 1709, so year over year, gold is down about 100 bucks. The gold to silver ratio, it's still over 91, so silver still fairly undervalued relative to the other precious metal. That's why I think silver is still the better buy at these prices. Now, are we near a bottom? Well, I think we definitely are much closer to a bottom than a top, and the top could be a lot higher than today's prices, and we'll be talking about why in today's video. But in today's environment, metals could drop. They could always drop in a big pan sell-off crash. The paper price could crash at any time. We're living in an environment where we've got a burgeoning global war. We've got an energy crisis. We have environmental and climate factors that are in play here. So there's always the potential for a black swan. But if we get business as usual in the economy, I think we are close to a bottom. And before we get into why, I do want to address some comments that I've had recently on the channel. If you've been watching, I'm still stacking at these prices. I view this as an opportunity, this pullback that we've seen in the metals. And I've had several comments asking, how can you be stacking when the price could fall further, and how can you recommend people stack? To answer that first, I want to say I'm not really giving any recommendations or financial advice on this channel. I'm just giving you my thoughts on the market. And everybody out there who's watching, everybody's situation is unique and different. So I don't give advice, I just tell people what I am doing and share my thoughts. And to be honest, taking delivery of physical precious metals like gold and silver, it is not for everybody. When you take gold and silver, physical metal, you take delivery of it, you're becoming a custodian of your own wealth. And the truth is that the vast majority of people, they don't do that. They don't have physical precious metals. They prefer to outsource the responsibility for their wealth to banks, to the Fed, to the government. And history tells us that in times of stability, this is the right way to go. Now, in times of massive change and instability, that's another story. And I'll just leave it to you to decide what kind of times you think we're living through at the moment. And some of the stories that I cover in today's video that might influence your perspective on that. So I am still adding metals personally. These silver dimes right here, I just got these in the mail from Hero Bullion. I bought them last week. I did pick them up before the big sell-off that we had on Thursday, so my timing was not impeccable, but still paid under $19 per dollar face value of junk silver. And it was just a listing for junk silver. I got some dimes. Now, I did put in the notes that I preferred mercury dimes if possible, so I guess that they read the notes over there at Hero Bullion, so thank you for that. I got some Roosevelts mixed in there as well, but mostly some mercuries and pretty nice looking dimes at that. Now, if you've seen my videos in the past, I love mercury dimes, junk silver dimes. I think that they're great because, one, they're not minting them anymore. They haven't minted them in like 6 decades, so there's a shrinking, dwindling supply, and the premiums on these coins have shot up recently, but I do forecast that that will be a trend that continues. That's why I am still stacking them, even with the higher premiums. And I just love dimes. They're divisible. If you want to get divisible bullion, typically there's a high premium, but with dimes, you get a really nice fractional silver piece there without the super high premiums that, say, the 1/10 ounce .999 rounds have. And speaking of silver dimes, I've got some very special ones here in these cards. Now, these were sent over to me from Dean DeWolf. He's the CEO and chief chemist and formulator over at Silver Botanicals, which happens to be today's video sponsor. Now, you can always check out Silver Botanicals In the description, I have a link, and you can use coupon code STACKER to save 10% off your order over there. And if you haven't checked them out yet, you should. They have awesome products. They utilize the power of nano silver in these personal care products. Like, for example, they have a deodorant, which is amazing. It's got essential oils and nano silver in it. It smells really good. And it's a lot better to control body odor with silver, completely non-toxic, than slathering on aluminum antiperspirants. I'm not a doctor or a chemist or anything, but from what I understand, aluminum is not particularly good for you. So that's just one example of the kind of products they make over there. But right now, we've got a special promotion from Silver Botanicals. And, Dean, he is a chemist focusing on the metals, including silver, and clearly it's one of his favorites. He kind of built his company around it. But he doesn't just believe in the chemical properties of silver. He also believes in the monetary principles, and therefore he has created these cards. Now, I think that these were probably inspired by the goldback. This is sort of Dean's answer to that, the homemade silverback here with a brilliant uncirculated Roosevelt dime in this laminate card. Now, these things are really cool. It tells you the years that the coins were minted, so that's the years for the Roosevelt dime. Tells you the silver content back here, so it's 0.0723 troy ounces of silver in the coin. Now, when you've got coins like this, you typically assume 0.0715 troy ounces for these circulated coins, but these dimes are all uncirculated, so no wear and tear on them. They've got the full amount of silver that they had when they were minted. And Dean is going to be giving away these cards to anybody who orders $50 or more from Silver Botanicals in the month of July. So you get 10% off your order with coupon code STACKER. And this month, if you buy more than $50 worth of product, you're going to get one of these thrown in with your order. So thank you very much to Dean for that. Those are super cool. If you're watching, let me know what you think of these cards. I think he did a really nice job with these. And, maybe something like this, if, we go into SHTF and you're trying to barter with some silver dimes, I don't know, maybe a card like this would be helpful in educating that potential trading partner. Even if we don't go into SHTF, these are super cool. So thanks again to Dean. Now, aside from the possibility of the shizzy hitting the fizzy, and, shout out to Canadian Prepper for that phrase. It's hard not to use it once you hear it. But apart from the possibility of global financial markets melting down and the need for silver to barter in our post-SHTF scenario, there are some other compelling reasons to continue to stack and why I believe silver has hit a bottom at these prices. The first thing is the latest commitment of traders chart from the COMEX. So to explain what you're looking at here, the lines that extend above the center line, those represent speculative long positions in silver. And then the lines that extend below the center line, those are commercial short positions. So you can see that the latest set of data released last Friday has extremely low speculative long positions and extremely low commercial short positions as well. Now, this is important for a couple of reasons. One, the speculative longs have drawn down to such a level that there's very few people left to sell. So, you need sellers to drive the price down. And if nobody is long, it makes it hard to sell. Also, the commercial short position has shrunk a lot. Now, the commercials are the smart money, and typically they get on the right side of the trade. And these are the lowest short levels that we have seen in years. Also, the lowest speculative long positions in years. So this is highly bullish for silver. And you got to consider also that the way that this data gets tabulated, it gets reported on a Tuesday and then it's published on Friday. So this latest set of data doesn't even represent the big sell-off that we had on Thursday yet. So likely this week's chart is going to be even more bullish. Also, we've got the ongoing Russian gas drama in Europe. And don't worry, this is related to silver. I am going to tie this into silver, so just stick with me here. A couple weeks ago, we had Gazprom reducing the flows of gas to Europe through that Nord Stream pipeline. They had cut the flows to about 40% of its capacity. And then on July 11th, they shut off the pipeline completely. Now, that's for routine maintenance, but the rumors are that Gazprom may not reopen that Nord Stream pipeline. On Friday, they issued force majeure letters to a number of buyers of Russian gas. And what Gazprom is claiming here with this force majeure is that an act of God or events outside of their control is going to prevent them from meeting their contractual obligations to those buyers. Uniper, that's one of the biggest German utility companies, one of the biggest buyers of Russian gas, they said that they reject the claim of force majeure and that it's baseless. And speaking of Uniper, they're about to go bankrupt and they're going to get bailed out from the government in Germany as well. They're going to probably take some state ownership of that company to keep it afloat. But, that's a bit of a digression. But despite the fact that Gazprom is issuing these letters and there's been all this speculation that they won't resume gas flows on Friday here on the 22nd, today Reuters reported that they would be resuming flows at the levels before July 11th. So not the full capacity, but they'll be resuming the roughly 40% flow. Now, Reuters gave kind of a vague source for this story. They said it was according to two people familiar with the situation. But regardless of how vague the source was, the news was enough to trigger a rally in the euro, in European stocks. The US dollar index fell on this news. So we'll see in a few days. On the 22nd, we will know if gas is flowing through the Nord Stream pipeline one way or the other. But this whole thing with Uniper, how they're requiring a bailout from the government, that is a sign that the cracks are really starting to show in the European economy. And even if the flows of gas do resume, there's still going to be an energy crisis. It just won't necessarily be as bad as if they were to cut off the gas completely. But, don't forget that we're basically in a proxy war with Russia. So if they do resume flows, it's going to be out of self-interest, not out of any charity towards Europe. And there is also the possibility, that Gazprom is just waiting for the right time to cut the flow of gas for it to be the most painful for the Europeans. Because the Europeans, they're already talking about how they're going to phase out Russian gas completely. They have all these plans to eventually phase out the Russian gas. So aside from whatever revenue they'd be receiving, it doesn't really do Russia any good to remain the supplier of European gas. And in other news, Gazprom also recently signed a deal with Iran to help them develop their own natural gas and crude oil production capacity. But I don't think any of that gas is going to be making its way over to Europe either. Likely that will be remaining with China and India and Russia and that block of eastern countries that we're sort of seeing the split, just like Zoltan Pasar forecast back in March following the Russian invasion of Ukraine. He said that the world would split into these economic blocks, and it looks like that's what's happening. Turkey, Egypt, and Saudi Arabia now are talking about joining the BRICS nation, so I guess they're going to have to amend that acronym. Right now, it's Brazil, Russia, India, China, and South Africa, but now it's going to have Turkey, Egypt, and Saudi Arabia in there as well. And that is quite strange because, Turkey is a NATO member, so we're going to have a NATO member joining BRICS, and the world just continues to get twistier every day. But perhaps of more concern is Saudi Arabia joining BRICS. It was just earlier this year that the Saudis were considering accepting yuan from China in exchange for Saudi oil. And perhaps if they get into the same economic union, that might become a reality. And that certainly would be bad news for the dollar. That would be eroding the petrodollar system that has been key to maintaining the dollar's world reserve status over the past 50 years. And speaking of China, China is now dumping U.S. debt. The holdings of U.S. debt in China just fell below $1 trillion for the first time since 2010. And none of this bodes well for the long-term prospects of the U.S. dollar. China, now that they have become net sellers of U.S. debt, that is going to exert continued upward pressure on U.S. bond yields because if you have people selling into the market, competing with you, trying to issue this debt or sell the debt, and we don't have the buyer of the Federal Reserve anymore, they've stopped buying bonds, so that's going to exert an upward pressure on yields because you need to offer a higher yield to incentivize further buying. The Fed, they're supposed to be, engaging on this quantitative tightening, so they're not buying bonds anymore, at least that we know of, not openly. But even if you just look at the publicly available balance sheet provided by the St. Louis Fed, you can see that the Fed balance sheet peaked back in April. It was about $8,965 billion back in April. And then the most recent data, it's only down to $8,895 billion. So in that time period, they have managed to reduce the balance sheet by about $70 billion, which is about 0.7% of the total balance sheet. So, the quantitative tightening thing, I really just have a hard time believing that it's ever going to get any traction. Why has the balance sheet shrunk so little so far? Because they can't. They can't keep selling these bonds in any quantity because it will drive rates up even higher, even faster, and that could trigger a debt crisis. So here's a forecast for me. I would personally be shocked if the Fed manages to get the Fed balance sheet under $8 trillion before they reverse policy and begin buying bonds again. And reverse they will. We're already seeing signs of that in Europe. On Friday, Bloomberg reported that the European Central Bank will be announcing a new tool for bond buying. This is to avoid fragmentation in the European debt market. And the thing about the EU is that all the countries there, they have the same currency, but they manage their economies and their governments and their spending separately. Now, according to the European Central Bank's charter, it's not supposed to fund these governments, but this tool whereby they're going to be able to buy bonds, buying bonds of a country is basically funding it through your central bank. And Germany tends to get upset when these measures and tools come up or get used. But then the weaker economies in the EU, like Italy and Greece, who, by the way, just saw their yields spike up in June to about 4%, which is dangerously high. They're concerned that these weaker countries, their bonds are going to diverge wildly from the bonds of the countries with stronger economies. And so this tool should allow them to manage a spike in bond yields. But in order to do that, they're going to have to go into the market. And Bloomberg conducted a poll of economists. 2/3 of them thought that this tool will have to be used at some point, and then 90% of the economists polled believed that the tool will involve unlimited bond buying. Now, at the moment when they're talking about implementing this tool, they act like it'll be used very conservatively and a very specific set of circumstances will have to be met in order for the ECB to go in and buy these bonds. But, when there's a crisis, you know how this tool is going to be used. It's not going to be used in any kind of a restricted way. If you're including in the wording of the tool the word unlimited bond buying, it's going to be unlimited. And, bond buying, QE, debt monetization, it's all the same thing. So if we see this in Europe, we are likely to see it here in the US. And all of this is the same thing. It's just paying for spending with inflation by monetizing government debt using the central bank. The central bank prints the currency, they buy the debt, they loan it to the government spends it, it's all inflation. And the idea that these balance sheets are ever going to get shrunk and they're ever going to not monetize this debt because it's just temporary. Just look at the Fed balance sheet. How far do you really think they're going to get with QT? And, the reason that all of this is tied together is we're going to see a major energy crisis in Europe. And whether we see it on July 22nd or we see it later this year when Russia finally decides to cut the gas, maybe they're waiting until the winter, until it's really cold and everybody really needs gas, and then they'll cut it and they'll make sure that people haven't had time to reduce their dependency. But, right now, they need a ton of gas over there. They're burning through lots of gas in Europe because they've got these record heat waves. They've got the highest temperatures on record in a bunch of places. Thousands of people dying of heat-related injuries in Portugal and Spain. And they're forecasting that this is going to get worse and travel into more northern reaches of Europe. The UK is already hot. Netherlands and Germany are supposed to be getting it shortly. So, there's all sorts of things driving up energy and gas consumption in these European countries. And when they have this energy crisis, likely these tools, including the unlimited bond buying, are going to be used. There's going to be a financial crisis, and it's not likely that that stays localized to Europe if it happens. It will spread here as well. I suspect that sooner rather than later, we're going to see more QE from the Fed. We're going to see the Fed balance sheet expanding rather than shrinking. And all of this is why, in the short term, even if silver hasn't bottomed yet, I am still happy to trade some digital representations of fiat currency for real hard money that I can hold in my hand. So let me know what you think in the comments down below. Thank you all very much for watching. Don't forget to like, comment, subscribe, and I will catch you next time. Smart Silver Stacker, out.